In the late 1990s, Enron was one of the most admired companies in the United States. Its executives were treated as pioneers of a new financial era. Investors believed the company had reinvented how energy markets worked. Enron claimed it was no longer simply a pipeline company. It described itself as a sophisticated energy trading platform. The company reported rapid and consistent profit growth. Its stock price climbed steadily throughout the decade. By 2000, Enron's market value exceeded $60 billion. Financial analysts praised its innovation and complexity. But inside the financial statements, a different structure existed. An accounting scam had been embedded inside the reporting system. Future profits were recorded immediately using projected estimates. Losses and debt were transferred into off-balance sheet partnerships. Complex financial structures made the numbers difficult to interpret. On paper, Enron appeared stable and highly profitable. In reality, much of the reported performance was manufactured. When confidence finally broke in 2001, the structure collapsed rapidly. Enron revealed how accounting systems can be used to construct financial illusions.
During the late 1980s and early 1990s, the United States energy industry began changing rapidly. Government regulators started loosening rules that had long controlled electricity and natural gas markets. The goal was to introduce competition and improve efficiency across the energy sector. Instead of fixed pricing structures, energy could increasingly be traded in open markets. This transition created entirely new opportunities for financial intermediaries. Companies that could manage energy flows and contracts gained strategic advantages. Enron was originally built around a network of natural gas pipelines. The company transported gas from producers to utilities and industrial customers. Pipeline companies traditionally earned stable but limited profits. Their business model depended on regulated infrastructure fees. During the early 1990s, Enron's leadership saw a different opportunity. Rather than only moving gas physically, the company could trade energy contracts financially. This approach resembled the way financial markets traded commodities and derivatives. Energy would become a tradable financial product. Contracts could be bought and sold without requiring physical delivery. Jeffrey Skilling, who joined Enron in 1990, strongly supported this transformation. He promoted the idea that Enron should operate as a market maker. In this role, Enron would stand between buyers and sellers of energy. The company would create liquidity in newly deregulated energy markets. Instead of earning pipeline fees, Enron could profit from trading margins. Each transaction generated small spreads that accumulated over time. Deregulation made this model possible. Utilities and producers needed intermediaries to manage complex contracts. Enron positioned itself as the central platform for these transactions. The company began building large trading desks in Houston. Teams of traders negotiated contracts covering electricity, natural gas, and other energy products. Over time, Enron expanded the concept further. The company experimented with trading bandwidth, weather derivatives, and other commodities. Energy markets were evolving into financial markets. Financial innovation became part of Enron's identity. Executives described the company as a pioneer of modern market design. Media outlets increasingly framed Enron as a visionary organization. Business magazines ranked it among the most innovative companies in America. Investors responded positively to the narrative. The company's growth story appeared aligned with broader deregulation trends. Energy trading revenues expanded throughout the 1990s. Wall Street analysts viewed the transformation as evidence of strategic brilliance. Few observers questioned how sustainable the model truly was. Complexity was interpreted as sophistication rather than risk. The regulatory environment allowed companies wide flexibility in structuring financial transactions. This flexibility made experimentation possible. It also reduced transparency in how profits were generated. The foundations of Enron's later accounting structures were being established during this period. Deregulation created space. Incentives shaped behavior.
By the mid-1990s, Enron was no longer presenting itself as a traditional energy company. Executives increasingly described the firm as a sophisticated trading platform. Energy contracts were treated as financial instruments rather than physical commodities. Electricity, natural gas, and other resources could be bought and sold through complex agreements. This approach allowed Enron to expand beyond pipelines and infrastructure. The company began positioning itself as a central intermediary in newly deregulated markets. Traders in Houston negotiated thousands of contracts each day. These agreements involved utilities, producers, and large industrial consumers. The business resembled financial markets more than traditional energy operations. Enron's leadership actively promoted the idea that it had created a new economic model. Jeffrey Skilling became the most visible advocate of this transformation. He frequently described Enron as an innovator in market design. Executives argued that energy markets were becoming information systems. Success would depend on managing contracts, prices, and risk. This narrative appealed strongly to investors during the technology boom of the late 1990s. Financial media amplified the message. Business publications repeatedly ranked Enron among the most innovative companies in America. Fortune magazine placed Enron at the top of its innovation rankings for several consecutive years. These rankings reinforced the company's reputation for sophistication. Investors interpreted complexity as evidence of advanced strategy. The company expanded trading operations into new categories. Enron Online launched in 1999 as a digital platform for energy transactions. Customers could buy and sell energy contracts through the Internet. The platform increased the volume and speed of trading activity. More transactions produced larger reported revenues. The company's financial statements reflected rapid expansion. Wall Street analysts praised the scale of Enron's trading operations. The narrative of innovation became central to the company's identity. Employees were encouraged to view themselves as participants in a revolutionary market system. Internal culture rewarded aggressive deal-making. Performance reviews emphasized revenue generation and market expansion. Success was measured by transaction volume and reported earnings growth. This culture reinforced the external narrative presented to investors. As the reputation expanded, scrutiny declined. Many analysts admitted that Enron's financial disclosures were difficult to interpret. Complex transactions were often explained using technical language. Few outsiders fully understood the structure behind reported profits. The company's reputation functioned as a shield against deeper questioning. Confidence in management replaced verification of financial mechanics.
As Enron expanded its trading operations, the company adopted an accounting method that would shape its financial reporting. This method was known as mark-to-market accounting. The rule allowed companies to record the present value of future profits immediately. Instead of waiting years for contracts to generate revenue, projected earnings could be recognized at once. For a trading company managing long-term energy contracts, this method appeared useful. Enron argued that it reflected the economic value of its deals. When the company signed a long-term agreement, accountants estimated the total profit expected over the life of the contract. That estimate could extend 10 or even 20 years into the future. Once the estimate was calculated, the projected profit was recorded immediately as revenue. The entire expected gain appeared on the income statement in the current reporting period. Future years would then rely on updated estimates rather than realized cash flows. This process required complex financial modeling. Accountants and traders worked together to forecast energy prices and demand patterns. Small changes in assumptions could produce large differences in reported profits. Because many of the contracts were unique, there were few external benchmarks. Enron therefore relied heavily on internal valuation models. These models allowed significant discretion in determining projected earnings. In theory, mark-to-market accounting required continuous reassessment of contract value. If projections changed, companies were expected to update the recorded profit. In practice, revisions often occurred slowly. Reported earnings therefore remained stable even when market conditions shifted. The method produced the appearance of steady financial growth.
Quarter after quarter, Enron reported expanding profits. Investors saw a company generating consistent performance. However, much of the reported revenue represented forecasts rather than realized income. Cash flows were frequently far smaller than reported profits. The accounting system transformed expectations into present results. This structure worked effectively as long as confidence remained strong. As the company signed new deals, new projected profits could be recorded. Future earnings estimates continually replenished the income statement. The process reinforced the image of a rapidly expanding enterprise. Few investors examined how much of the income depended on long-term projections. Financial statements became increasingly complex. Understanding the underlying contract required specialized knowledge. Most market participants relied on summary figures rather than detailed disclosures. Reported profits therefore shaped the market narrative. Rising earnings supported rising stock prices. The accounting framework turned assumptions into financial performance. For Enron, mark-to-market accounting became a central reporting tool. It allowed the company to present growth even when cash generation was uncertain. The distinction between realized income and estimated profit gradually blurred. Over time, projections began to substitute for measurable performance.
As Enron expanded its trading operations, the company adopted an accounting method that would shape its financial reporting. This method was known as mark-to-market accounting. The rule allowed companies to record the present value of future profits immediately. Instead of waiting years for contracts to generate revenue, projected earnings could be recognized at once. For a trading company managing long-term energy contracts, this method appeared useful. Enron argued that it reflected the economic value of its deals. When the company signed a long-term agreement, accountants estimated the total profit expected over the life of the contract. That estimate could extend 10 or even 20 years into the future. Once the estimate was calculated, the projected profit was recorded immediately as revenue. The entire expected gain appeared on the income statement in the current reporting period. Future years would then rely on updated estimates rather than realized cash flows. This process required complex financial modeling. Accountants and traders worked together to forecast energy prices and demand patterns. Small changes in assumptions could produce large differences in reported profits. Because many of the contracts were unique, there were few external benchmarks. Enron, therefore, relied heavily on internal valuation models. These models allowed significant discretion in determining projected earnings. In theory, mark-to-market accounting required continuous reassessment of contract value. If projections changed, companies were expected to update the recorded profit. In practice, revisions often occurred slowly. Reported earnings, therefore, remained stable even when market conditions shifted. The method produced the appearance of steady financial growth. Quarter after quarter, Enron reported expanding profits. Investors saw a company generating consistent performance. However, much of the reported revenue represented forecasts rather than realized income. Cash flows were frequently far smaller than reported profits. The accounting system transformed expectations into present results. This structure worked effectively as long as confidence remained strong. As the company signed new deals, new projected profits could be recorded. Future earnings estimates continually replenished the income statement. The process reinforced the image of a rapidly expanding enterprise. Few investors examined how much of the income depended on long-term projections. Financial statements became increasingly complex. Understanding the underlying contracts required specialized knowledge. Most market participants relied on summary figures rather than detailed disclosures. Reported profits, therefore, shaped the market narrative. Rising earnings supported rising stock prices. The accounting framework turned assumptions into financial performance. For Enron, mark-to-market accounting became a central reporting tool. It allowed the company to present growth even when cash generation was uncertain. The distinction between realized income and estimated profit gradually blurred. Over time, projections began to substitute for measurable performance. By the late 1990s, Enron's financial narrative had become highly persuasive to investors.
The company reported consistent earnings growth across multiple years. Wall Street analysts described Enron as a model of modern corporate strategy. Its trading platform appeared to dominate emerging energy markets. The broader economic environment also supported this perception. The late 1990s technology boom pushed investors toward companies associated with innovation. Businesses presenting themselves as market disruptors attracted large amounts of capital. Enron positioned itself within this environment. Executives emphasized technology, digital platforms, and sophisticated trading systems. This messaging aligned with investor enthusiasm during the Internet era. As a result, Enron's stock price climbed steadily. Throughout the 1990s, the company's market value expanded dramatically. By August 2000, Enron's share price exceeded $90. At its peak, the company's market capitalization reached tens of billions of dollars. Rising stock prices reinforced investor confidence. The company's reported profits appeared to justify the valuation. Wall Street analysts continued issuing optimistic recommendations. Media coverage praised Enron's innovative business model. Inside the company, executive compensation increasingly depended on stock performance. Bonuses and stock options rewarded senior managers for maintaining high share prices. This compensation structure created powerful financial incentives. Executives benefited directly from continued increases in the company's valuation. When share prices rose, personal wealth increased as well. Some executives began selling portions of their stock holdings. These transactions generated large personal profits. At the same time, employees were often encouraged to hold company shares inside retirement accounts. Many workers accumulated significant exposure to Enron stock. Externally, the market narrative remained positive. Investors saw a company expanding into multiple trading sectors. Energy, broadband capacity, and weather derivatives were all presented as growth opportunities. The complexity of these operations made independent evaluation difficult. Financial statements continued to report strong earnings. Analysts relied heavily on the company's explanations of its business model. The rising share price became evidence of success. Market valuation reinforced the credibility of reported performance. Few investors examined how much of the company's income depended on projected profits. As long as the share price increased, the system appeared stable. Incentives throughout the organization favored maintaining this appearance. Executives, analysts, and investors all benefited from continued optimism. But the company's financial structures still depended heavily on confidence. Incentives reward appearance, not durability. By early 2001, signs of strain were beginning to appear inside Enron. Several internal employees had started questioning the company's accounting structures. Concerns focused on the complex partnerships used to move liabilities away from the balance sheet. Some employees believed the arrangements created significant financial risk. One of the most notable warnings came from Sharon Watkins. Watkins was a vice president within Enron's corporate development group. In August 2001, she wrote a memo to Enron's chairman, Kenneth Lay. The memo described serious concerns about the company's accounting practices. Watkins warned that the partnership structures could eventually collapse under scrutiny. She also suggested that the accounting arrangements might attract regulatory attention. Her message emphasized the potential consequences if investors lost confidence. The memo described the possibility of a sudden financial crisis. Watkins noted that many employees inside the company did not fully understand the partnerships. She warned that the structures could unravel quickly if market conditions changed. Despite these warnings, the internal response remained limited. Senior leadership did not immediately initiate a comprehensive review. Executives expressed confidence in the company's accounting methods. The partnerships had been operating for several years without public controversy. This history created a sense of institutional comfort. Internal culture also discouraged open criticism of the company's strategy. Enron maintained a performance evaluation system known as rank and yank. Employees were ranked against one another, and lower performers were regularly dismissed. This system created intense pressure to demonstrate success. Questioning financial structures could be interpreted as disloyalty. As a result, many employees avoided challenging executive decisions. The company's reputation for innovation further reinforced this behavior. Employees often believed the complexity reflected sophisticated strategy. Few individuals felt confident challenging accounting models designed by senior leadership. External auditors had also approved many of the company's reporting practices. This approval provided additional reassurance within the organization. Consequently, early warnings did not trigger immediate structural reform. The system continued operating largely unchanged during much of 2001. Meanwhile, Enron's stock price began showing increased volatility. Market confidence remained generally positive, but uncertainty was emerging. Internally, the complexity of the financial structures made rapid correction difficult. Many obligations were embedded inside interconnected partnerships. Unwinding the system would have required major financial disclosure. Leadership instead focused on maintaining investor confidence. Transparency threatens unstable structures.
By mid-2001, some financial analysts began examining Enron's disclosures more closely. Questions emerged about the complexity of the company's financial statements. Enron's annual reports contained hundreds of pages of financial information. However, the structure of the partnerships and trading contracts remained difficult to interpret. Analysts attempting to model the company's finances often encountered missing details. Several observers noted that the company's reported profits did not align with its cash flow. Earnings appeared strong, but operating cash generation was inconsistent. This discrepancy raised questions about how profits were being calculated. Some analysts began asking executives to clarify the structure of the partnerships. Conference calls with investors increasingly included technical accounting discussions. Enron's leadership responded by emphasizing the sophistication of the company's business model. Executives argued that traditional accounting analysis could not fully capture the value of energy trading markets. They maintained that the company's financial methods reflected advanced market innovation. Many analysts accepted these explanations. The company's reputation for complexity discouraged deeper challenges. Financial journalists also struggled to explain the structure clearly. The partnerships involved multiple layers of contracts and guarantees. Understanding their economic impact required detailed internal data. At the same time, Enron's external auditor played a central role in validating the financial reports. Arthur Andersen was responsible for reviewing Enron's accounting practices. The firm had a long-standing professional relationship with the company. Andersen auditors reviewed the partnership structures and financial disclosures. Their approval reassured investors that the accounting methods met regulatory standards. This endorsement reduced pressure for deeper investigation. However, some analysts continued raising questions during 2001. A few investors began examining Enron's balance sheet more cautiously. Market confidence remained strong, but skepticism was slowly increasing. The complexity that once impressed investors was beginning to create uncertainty. Financial structures that are difficult to understand also become difficult to trust. As scrutiny increased, Enron's leadership intensified efforts to reassure the market. Public statements emphasized stability and continued growth. Executives maintained that the company's financial position remained strong. Yet the same complexity that delayed criticism also concealed structural weaknesses. When financial systems depend on opacity, transparency eventually becomes unavoidable.
Questions continued accumulating throughout 2001. Each inquiry increased the pressure on the company's financial narrative. Complexity delays collapse, but does not prevent it. By the second half of 2001, Enron's financial structure began to unravel publicly. In October 2001, the company announced a significant earnings restatement. The restatement reduced previously reported profits by hundreds of millions of dollars. It also acknowledged problems involving the off-balance sheet partnerships. Investors began examining the company's financial disclosures more carefully. Confidence that had taken years to build began weakening quickly. Credit rating agencies started reviewing Enron's financial stability. Debt obligations and partnership guarantees suddenly received greater attention. As scrutiny increased, market confidence deteriorated. Enron's share price began falling rapidly. Only months earlier, the stock had traded near historic highs. By late October, the decline had accelerated sharply. Investors worried that the company's liabilities were far larger than previously understood. The partnership structures that had hidden debt were now being reassessed. Financial analysts attempted to calculate the full scale of Enron's obligations. However, the complexity of the structures made accurate estimates difficult. Credit agencies responded by downgrading the company's debt ratings. These downgrades created additional pressure on Enron's finances. Many of the partnership arrangements depended on strong credit ratings. If ratings fell below certain thresholds, the partnerships could collapse. This mechanism quickly destabilized the entire financial structure. Counterparties began reducing their exposure to Enron. Trading partners demanded additional guarantees before completing transactions. The company's liquidity position weakened rapidly. Executives attempted to reassure investors and stabilize the situation. Public statements emphasized that the business remained fundamentally sound. However, markets had already begun adjusting their expectations. In early November 2001, Enron attempted to negotiate a merger with Dynegy. The proposed deal was intended to restore market confidence. Initially, the announcement slowed the decline in the company's stock price, but further disclosures about Enron's financial condition continued emerging. As new information appeared, Dynegy withdrew from the proposed acquisition. Without the merger, Enron faced immediate liquidity pressure. Credit lines were reduced and counterparties withdrew support. The company no longer had sufficient confidence from lenders or trading partners. On December 2, 1991, Enron filed for Chapter 11 bankruptcy protection. At the time, it was one of the largest corporate bankruptcies in American history. Billions of dollars in shareholder value disappeared within weeks. The collapse revealed how dependent the system had been on continued confidence. Confidence evaporates faster than it builds. Enron's bankruptcy quickly triggered consequences beyond the company itself. Attention turned toward the institutions responsible for oversight. One of the most significant was the accounting firm Arthur Andersen. Arthur Andersen had served as Enron's external auditor for many years. The firm was responsible for reviewing the company's financial statements. Auditors were expected to verify that accounting practices followed regulatory standards. In Enron's case, Andersen had approved the company's complex reporting structures. These included the use of mark-to-market accounting and off-balance sheet partnerships. After the collapse, regulators began investigating how these structures had been approved. Questions emerged about the independence of the audit process. Arthur Andersen had received substantial consulting fees from Enron. This relationship raised concerns about potential conflicts of interest. As investigations progressed, another issue surfaced inside the firm. Employees had destroyed large quantities of Enron-related documents. The shredding occurred during the early stages of regulatory inquiry. Investigators interpreted the destruction as obstruction of justice. In March 2002, the United States Department of Justice charged Arthur Andersen with obstruction. The charge focused on the firm's handling of Enron-related audit documents. The legal case placed the entire accounting firm under intense scrutiny. Arthur Andersen had once been one of the largest auditing firms in the world. The company employed tens of thousands of professionals globally. However, the criminal charge quickly damaged its reputation. Many corporate clients began terminating their relationship with the firm. Without clients, the Andersen business model became unsustainable. The firm's workforce rapidly declined. Within months, Arthur Andersen effectively ceased operating as a major accounting organization. Although the U.S. Supreme Court later overturned the conviction in 2005, the damage was irreversible. The firm had already lost its global client base. Its role in the Enron collapse became a defining moment for the auditing profession. Regulators and policymakers began reconsidering how corporate audits were supervised. The scandal exposed weaknesses in oversight systems. Auditors were expected to function as independent verification mechanisms. When those mechanisms fail, financial statements lose credibility. The Enron case therefore affected more than one corporation. It challenged confidence in the broader financial reporting system. Investors rely heavily on audited financial information. When auditors fail to detect or challenge risky structures, the system weakens. Arthur Andersen's collapse demonstrated how oversight institutions can be damaged by association. The consequences extended across the accounting industry. Trust in financial reporting required rebuilding. When oversight fails, trust collapses with it. Following Enron's bankruptcy in December 2001, regulatory and criminal investigations expanded rapidly. Federal agencies began examining the company's accounting practices and executive decisions. Investigators focused on how Enron's financial statements had been constructed. They also reviewed the role of senior executives in designing the partnership structures. Several individuals within the company became central figures in the investigations. One of the most prominent was Jeffrey Skilling. Skilling had served as Enron's chief executive officer during the company's final years. He had previously been the chief architect of the company's trading strategy. Prosecutors argued that Skilling had misled investors about the company's financial condition. They claimed that public statements presented an overly optimistic picture of Enron's stability. Another key figure was Kenneth Lay. Lay had founded Enron and served as chairman for most of the company's history. He had also returned as chief executive officer shortly before the collapse. Investigators examined whether Lay had been aware of the partnership structures. The legal process required reviewing extensive financial documentation. Emails, contracts, and accounting records were analyzed in detail. Several former executives agreed to cooperate with investigators. Their testimony helped prosecutors reconstruct how the financial structures had operated. Andrew Fastow, Enron's chief financial officer, became a central figure in the investigation. Fastow had helped design many of the special purpose entities used to move liabilities. He eventually pleaded guilty to fraud-related charges. Fastow agreed to testify against other senior executives. His cooperation provided insight into the company's internal decision-making. The legal trials attracted significant public attention. The proceedings examined years of corporate transactions and accounting decisions. In 2006, Jeffrey Skilling was convicted on multiple counts of fraud and conspiracy. He received a substantial prison sentence as a result. Kenneth Lay was also convicted on several charges. However, Lay died shortly before his sentencing, which ended the legal process against him. The legal outcomes emphasize the responsibility of corporate leadership. Executives hold authority over financial reporting and strategic decisions. When financial information is presented inaccurately, investors bear the consequences. The Enron collapse had already caused billions of dollars in losses. Many employees also lost retirement savings tied to company stock. Legal accountability occurred only after the financial damage had been realized. Court decisions addressed misconduct but could not reverse the losses. The investigations demonstrated how complex financial systems can conceal responsibility. Fraud prosecuted after damage is done. The Enron collapse became one of the most studied corporate failures in modern financial history. Researchers, regulators, and investors examined the case to understand how the system had failed.
Several structural elements appeared repeatedly throughout the investigation. One element was aggressive accounting practices. Mark-to-market accounting allowed projected profits to appear immediately in financial reports. These projections were often based on internal valuation models. Because the contracts were complex, external verification was difficult. Another structural feature involved off-balance sheet liabilities. Special purpose entities allowed large obligations to remain outside the parent company's financial statements. This arrangement created the impression of lower corporate debt. However, the economic risk remained connected to Enron. When market conditions changed, the hidden liabilities returned to the company. Reputation also played an important role in maintaining the structure. Enron had cultivated an image of innovation and market leadership. Financial analysts and media organizations reinforced this perception. The reputation reduced pressure for detailed scrutiny. Complexity further protected the system. Financial disclosures were technically compliant but difficult to interpret. Most investors relied on summary figures rather than underlying mechanics. Stock-based compensation added another incentive layer. Executives benefited financially from rising share prices. Maintaining market confidence, therefore, became a central priority. These incentives encouraged the continuation of aggressive financial structures. As long as confidence remained strong, the system appeared stable. However, once scrutiny intensified, the weaknesses became visible quickly. Losses previously hidden inside partnerships returned to the balance sheet. Credit agencies downgraded the company's financial standing. Trading partners withdrew from transactions. Liquidity evaporated, and bankruptcy followed. The pattern observed in Enron has appeared in other financial scandals. Complex accounting structures can delay the recognition of economic reality. Off-book liabilities can hide risk temporarily, but not permanently. Reputation can shield companies from scrutiny for extended periods. Eventually, however, verification aligns with financial evidence. When this alignment occurs, the correction is often rapid. For regulators, the case highlighted the importance of transparency. For investors, it demonstrated the limits of trust without verification. Financial reporting systems depend on accurate information and independent oversight. When these mechanisms weaken, market confidence becomes fragile. Financial statements are narratives. Verification determines whether they are truth or illusion.